Before you make a single decision about your silver position today, pause for a moment and really absorb what is happening around you. It is Tuesday, March 17th, 2026. Silver is trading at $79.56, slightly down on the day. Across major financial media outlets, the narrative is strikingly uniform. Analysts are telling you that silver is falling because the Federal Reserve is expected to pause rate cuts tomorrow. The explanation sounds clean, logical, and familiar. Higher rates typically pressure precious metals. It feels like a textbook moment. But that explanation, while not entirely false, is incomplete in a way that matters far more than most people realize. What you're being given is not the full story. It is a simplified version, one that stops just short of asking the deeper questions. It leaves out critical context that could completely change how you interpret the current price action. The danger is not in what is being said, but in what is being left unsaid. Because if you act based on an incomplete narrative, you risk making decisions that benefit others far more than they benefit you. Right now, there's a number that deserves your attention more than the silver spot price or any stock index. That number is 3. 5 to 3, 75%, the Federal Reserve's benchmark interest rate. Market expectations suggest that the Fed is almost certain to hold that rate steady in the upcoming announcement. On the surface, that sounds uneventful. A pause implies stability, or at least control, but the reason behind that pause is where things become far more significant. Central banks typically pause for one of two reasons. Either the economy has stabilized enough that further intervention is unnecessary, or the central bank finds itself in a position where any move, up or down, would trigger serious consequences. The first scenario is routine. The second is a warning signal. And based on the broader economic landscape, it is becoming increasingly clear that we are not looking at a calm, stable system. We are looking at one that is constrained, pressured, and unable to move freely without causing damage. Over the past decade, monetary policy has been shaped by extraordinary measures. After the financial crisis, interest rates were pushed to near zero and stayed there for years. This environment encouraged borrowing, inflated asset prices, and fundamentally reshaped how the financial system operates. Cheap money became the foundation upon which everything else was built. Governments, corporations, and individuals all adapted to that reality. Then came the pandemic, and with it, an unprecedented wave of stimulus. Money entered the system at a scale never seen before, while supply chains simultaneously struggled to keep up. The result was predictable. Inflation surged. To counter this, the Federal Reserve raised rates aggressively, moving from near zero to above 5% in a relatively short period. That shift was necessary to control inflation, but it came with consequences. Those consequences are still unfolding. Higher rates have strained parts of the financial system that were built on the assumption of cheap borrowing. Regional banks faced significant stress. The housing market slowed as mortgage rates climbed. Government debt became more expensive to service. The system did not collapse, but it was clearly tested. Now the Fed is pausing, not because everything is resolved, but because further action in either direction carries risks. Raising rates could intensify financial strain. Cutting rates could reignite inflation. This is not a position of strength. It is a position of limitation. At the same time, external factors are adding pressure. Energy markets, for example, remain highly sensitive to geopolitical developments. Disruptions in key regions can drive prices higher, feeding into broader inflation. And, unlike demand-driven inflation, which can sometimes be managed through interest rates, supply-driven inflation is far more difficult to control. A central bank cannot produce oil or resolve geopolitical conflicts. Its primary tool, interest rates, has limited effectiveness in these situations. This creates a complex environment. Inflation is influenced not just by monetary policy, but by global events, supply constraints, and structural factors. The Fed's pause, therefore, should not be interpreted as a simple signal of stability. It reflects a balancing act in a system that is dealing with multiple pressures at once. Now consider how silver fits into this picture. Precious metals have historically responded to a range of factors, including interest rates, inflation expectations, currency strength, and investor sentiment. In the short term, prices can move based on expectations around Fed policy. But over longer periods, broader dynamics tend to play a more significant role. The recent movement in silver, declining slightly from around $81 to $79.56, represents a relatively modest pullback. In percentage terms, it is a small move, especially considering the level of attention surrounding the Fed's upcoming decision. If the underlying outlook for silver were fundamentally weakening, you might expect more pronounced selling pressure. Instead, the price action appears measured, suggesting a degree of stability beneath the surface. Another important factor to consider is the relationship between gold and silver. Gold has seen strong upward movement, reflecting its role as a store of value in uncertain conditions. When gold rises significantly while silver lags, it often draws attention to the ratio between the two metals. Historically, that ratio has fluctuated widely, but it has also shown a tendency to revert towards certain averages over time. This does not guarantee any specific outcome, but it does highlight how relative pricing can shift depending on market conditions. If broader economic or monetary factors continue to support precious metals, both gold and silver may respond, though not always at the same pace. In addition to investment demand, silver has a significant industrial component. It is used in a variety of applications, including electronics, renewable energy technologies, and manufacturing processes. This dual role, both as an investment asset and an industrial input, gives silver a unique position. Industrial demand can provide a baseline level of support, while investment demand can amplify price movements during periods of uncertainty. That said, markets are complex, and no single narrative captures the full picture. Price movements are influenced by a combination of factors, including macroeconomic conditions, investor behavior, and global events. It is important to approach any analysis, whether bullish or bearish, with a critical mindset. What matters most is understanding the broader context. A single headline rarely tells the entire story. When you hear that silver is falling because of interest rate expectations, that may be part of the explanation, but it is unlikely to be the whole explanation. The financial system operates within a web of interconnected forces, and meaningful insights often come from looking beyond the surface. At times like this, it is easy to focus on short-term price changes and react accordingly. A red number on a screen can trigger uncertainty, but markets are not driven solely by daily fluctuations. They reflect ongoing processes, trends, and adjustments that unfold over longer periods. The Federal Reserve's current position is one piece of that puzzle. It reflects the challenges of managing an economy that has experienced significant shifts over the past decade. It also highlights the limits of monetary policy in addressing every type of economic pressure. Silver, like any asset, will continue to respond to these dynamics. Its price will move based on a combination of factors, some predictable, others not. The key is not to assume that any single explanation, especially one presented as simple and definitive, captures everything that is happening. Instead, take a step back and consider the bigger picture. Look at the interplay between monetary policy, inflation, global events, and market behavior. Recognize that uncertainty is a natural part of financial systems, and that periods of tension often bring both risks and opportunities. Ultimately, decisions about investments should be based on careful consideration, not on incomplete narratives or emotional reactions. The current environment is complex, and it requires a thoughtful approach. By staying informed, asking deeper questions, and maintaining perspective, you can navigate that complexity more effectively. The price of silver today is just one data point. What matters more is understanding the forces behind it and recognizing that those forces are still evolving.